Hello and welcome to the Global View on this Wednesday. I'm Andrew Gagan. Great you can join us again here at AusBiz. Let's see what happened overnight. Now, China has retaliated. In fact, this came late yesterday, just as our own market closed. It's come up with its own targeted tariffs in response to the imposition of US tariffs on Chinese goods. But optimism for a trade breakthrough between the US and China did buoy investors on Wall Street, lifting the major indices higher, with President Trump having delayed tariffs for Canada and Mexico. China announced a wide range of measures targeting US businesses, including Google, despite the fact that its search engine is blocked in China. A 10% tariff has also been placed on imports of US farm equipment that could impact firms such as Caterpillar and Deere, and on electric trucks imported from the US, and that could apply to Tesla's Cybertruck. Biotech firm Illumina also a target, while shares of PVH Corporation, the holding company of brands such as Calvin Klein, fell after China placed the companies on its unreliable entity list. Now, in earnings results, Alphabet reported after the bell, sending its shares down around 7%. That's after a missed quarterly revenue estimates, despite a 30% increase in cloud revenue led by growth in its AI solutions business. Palantir shares surged after the data analytics company forecast first quarter and annual revenue above estimates. PepsiCo fell as it forecast annual profit below expectations and missed quarterly revenue estimates. And Estee Lauder shares plummeted, with the cosmetics company posting a weak quarter. Merck also fell, saying it would pause shipments of Gardasil to China as weak demand for the HPV vaccine there is expected to hurt the company's revenue. And PayPal fell heavily after the digital payment giant's operating margin shrank in the fourth quarter. Well, China is also targeting US coal, oil and gas exports, which could benefit Australian energy producers. However, more broadly, a slowdown in Chinese demand from US tariffs could affect the Australian economy. Well, China's tariffs on US imports will not take effect until next Monday, giving Washington and Beijing time to try to seek a deal. Though a planned phone call between President Trump and President Xi is now off, for now at least. Trump has said he may increase tariffs on China further unless Beijing stems the flow of fentanyl into the United States. However, China says that's America's problem and is challenging the tariffs at the World Trade Organization. Meanwhile, EU Trade Chief Maros Sefcovic said he wanted early talks with the US to ward off potential tariffs, saying, "We believe through constructive engagement and discussion we can resolve this problem." FOMC member Austin Goolsbee has said the Fed should be more cautious in cutting rates due to tariff risks, saying we now have got to be a little more careful and more prudent of how fast rates can come down because there are risks that inflation is about to start kicking back up again. And the latest US data, job openings in December rose 4.5%, slightly less than forecast, while factory orders in December fell 0.9%, which was a little more than expected. And the US two-year Treasury yield has fallen to 4.21%, the 10-year down around 4.52%. And the US dollar edged lower as President Trump's tariff threats were interpreted more as a negotiating tactic. The Aussie dollar, seen as a proxy for Chinese yuan, rose 0.5% to 62.5, well above yesterday's low of 60.8. That was its lowest level in almost 5 years. And Bitcoin has fallen back below 100,000 US dollars. On the commodities front, oil prices mixed in response to the tit-for-tat trade measures playing out globally. Brent futures at $76 a barrel, copper up more than 1%, iron ore more than 0.5% higher at 105 US dollars a tonne, and gold up more than 1% to another record at $2,843 an ounce, driven by investors seeking a safe haven asset amidst the developing trade war. Well, for more on that, those trade developments and the tariffs that we've seen and the impacts for investors, I caught up with Eric Souders from GSFM.
Yeah, I think Trump is keeping all of us on our toes, as expected to some degree. You know, I think it's a bit too early to tell in terms of the actual implementation, the magnitude, and the ultimately the implications of tariffs. Clearly he's suggested some things, and situation's been pretty fluid the last 24 hours. He kind of walked those back with Mexico and Canada. I think for us, we're trying to kind of zoom out and say, the state of the U.S. economy today is in a much different position than it was in 2016 when Trump first took office. Today, the U.S. economy it has very good growth. So growth has been very strong, but inflation is sticky. And in the first chapter of Trump, his first administration, growth was pretty benign, and inflation was also pretty benign. And so, we felt like he at that point in time could really institute countercyclical fiscal measures to help really boost growth without worrying much about inflation. So what does this have to do with tariffs? It has to do with tariffs because we think that Trump really campaigned on a promise to the middle class, which was inflation has reduced purchasing power. The middle class feels less well off today than they did 4 years ago, and so we're a bit skeptical at the ultimate magnitude and the implementation of tariffs. But it's clear that given his latest stance the last 24 hours or so, he's going to clearly use them as a negotiating tool. So I think that we expect tariffs to be used more from a negotiation standpoint than we do an actual implementation standpoint, given the fact that they are inflationary in nature, and that would really hurt the middle class that just got him elected.
Eric, what are the potential implications as far as Fed policy is concerned? In fact, we heard from FOMC member Austin Goolsbee most recently saying the Fed should be more cautious, just talking about, I guess, the risks for inflation in the wake of those tariffs.
Yeah, I think the Fed will probably view it as they have in the past, which is tariffs tend to be a one-time price adjustment rather than your classic central bank inflationary experience. So I think that the Fed will obviously take tariffs into consideration, but I think more importantly for them, I mean, they've got a sticky inflation backdrop in the U.S. And clearly they've cut rates 100 basis points the last several months. You've got an economy that is on very stable footing, arguably accelerating, all while inflation is pretty sticky. So I think the Fed is probably more focused on the structural underpinnings of the U.S. economy rather than the implications of tariffs.
How's this playing out with those treasury yields at the moment? We've seen some bull flattening essentially with those longer term rates falling faster than the short end.
Yeah, I think that makes sense. Investors are probably saying, tariffs, one-time price shock, inflationary in some ways, not in the classic central bank sense, but nevertheless puts pressure on prices. So front-end yields should rise modestly, and then it is theoretically a dampener of growth. Depending upon how you kind of extrapolate, all the implications of tariffs, some of the direct but also the indirect implications. It takes off about 0.5% of growth in the U.S. So in that case, you would expect long-end yields to move lower. So we think that flattening makes sense in recent days. And I think, again, kind of speaks to, the conundrum that the Fed is in with respect to the strength of the U.S. economy, particularly the last few months. And now you layer in, some implications with respect to prices.
So ideally, Eric, where do you think the place to be is when you're in fixed income then?
Yeah, I mean, I think again trying to kind of look through this noise. It is noise to some degree, just given we're not quite sure where things are headed. So I think we're focused on the fact that the U.S. economy is on stable footing. Growth is good. Wage growth has been between 4% and 5% for a couple of years running. Real growth has been north of 2% for almost 8 straight quarters. Asset prices are at all-time highs. The labor market is pretty solid. So the U.S. economy is on sound footing, and I think that for us, that probably means that corporate defaults will be pretty low. We're talking a lot about tariffs, but I think it's important to point out, some of Trump's likely corporate policies, which is going to be less regulation and lower taxes. So that should benefit corporations. We're seeing that in all sorts of sentiment indicators, hiring plans, things of that nature. So that probably means default rates will remain contained. That should be pretty good for corporate credit. Emerging market debt, believe it or not, we think there's some areas there that we think look pretty good. Interest rates have been coming down there. Inflation is by and large pretty well contained in emerging markets, and sovereign balance sheets look pretty healthy.
What of those mortgage-backed securities? What's your view on those?
Yeah, it's very fragmented globally. The U.S. has a different mortgage lending arrangement relative to other developed countries. We have the benefit of a 30-year mortgage here. Other areas like Canada, the UK, Europe, for example, have much shorter term lending arrangements. So I think that the U.S., although it looks pretty unaffordable, prices continue to be pretty sticky, moving higher, and refinancing risk is just not really prevalent in the U.S. relative to other parts of the world. So I think the residential part of the market looks pretty good. Commercial real estate, we're a little bit more cautious. You've seen a pretty healthy rise in long end yields. We do expect long end yields in the U.S. to continue to march higher. And then you've also seen a lot of optimism in commercial real estate really the last few months relative to 12 to 15 months ago. So we think the market may be a bit too over optimistic regarding the likely recovery in commercial real estate relative to where we think interest rates are headed, which is higher in the long end of the yield curve.
So what are the biggest risks as you see them right now then, Eric, and what do you want to avoid then?
Yeah, I think the U.S. economy, we don't have really a fundamental problem. I think we have a bit of a valuation problem. You sort of layer that in with sentiment, which seems pretty optimistic and pretty bullish. I think that complacency is something that we're concerned about, particularly when there are a lot of unknowns. Headlines are abundant, and so volatility should be elevated. And so in an environment where volatility is higher, really across the board, you have higher currency volatility, you have higher interest rate volatility, and you have higher volatility in the equity market. You need to be paid for that volatility. So I think that the biggest risk is that there's this mediocre intersection between valuation and really sentiment. Fundamentals are fine, but valuation and sentiment to us seems to be a bit too optimistic. So we've been bringing credit risk down in portfolios, and we've been adding interest rate risk in the U.S. in the front end of the yield curve. I mentioned we think rates are going higher in the long end, but we think the front end looks attractive given there's only one cut or so priced the next 12 months. And we know that in any sort of growth scare, the Fed would like to move rates lower. So we think the front end of the yield curve in the U.S. looks good. We think it's pretty cheap to the Fed's reaction function, and it's a good hedge for credit.
Eric Souders from GSFM. Right, let's come back home then as we're just about to get going on the local markets. So indications in SPY futures, we're going to have a very positive start there, up 0.6%. Just bearing in mind we saw a precipitous drop right at the close yesterday as that announcement came through from China that they were retaliating with their own tariffs on US goods. Stay with us. The open is just a couple of minutes away.